Welcome to this next video where we are going to talk about the buyer satisfying their financing contingency in your contract. So this video is going to be talking a little bit about one, if buyers are paying cash, because that's not necessarily a financing contingency, but how the buyers are financing their purchase. And we don't want to leave our sellers out of the equation of the course here if they are finding that they get an offer from a cash buyer. So we'll talk about that. And that will be pretty quick. And then after that, we'll talk about what what you can expect with buyers who are going to be purchasing with a mortgage. So if you have a buyer who's offering you cash, there's a couple things that we need to talk about. One is, how do you prove that they have the cash to make the purchase? And how do you protect yourself to make sure that on closing day, they will still have the cash to make their purchase? So number one is when they submit their offer to you, and during the attorney review process, it should be contingent that the buyer provide proof of funds from an account where they can redact, like their account number and their address, but their name should be on the account statement. So if we see that there is a account statement that's provided, but the name is unrelated to the buyer who's buying your property, we will start asking questions so that we can get down to the bottom of who that person is. Maybe they're the parents, maybe they're a relative, but we need to know what the relationship is, and we need that in writing so that we have a person to go to if something goes awry. So that's number one. Number two, there should also be a placeholder in the attorney review letters that provide for when we get close to closing, that we can also get another submitted proof of funds that basically shows one more time prior to closing that the funds are in an account, so that we can have assurance that when we're like 3 days away from closing, that the funds are there and that the buyers are now prepared to submit their funds for closing. On closing day, what's really awesome is closing day does not require a lender to be involved because the buyers are paying cash. So the whole thing actually happens completely virtually. The buyers can wire their funds from their local bank. They will sign a document that's called a HUD, which is a statement that you will also sign that goes over the final figures. And that document can be e-signed for closing. And when you go to sign your portion, you can also sign that e-sign. And when the funds clear the title company from the buyer, those funds will then be dispersed so that everybody who needs to get paid as part of the transaction gets paid, and your mortgage gets paid off if you have one, and your proceeds get sent to you. So all in all, cash closings kind of happen throughout the day on a specific day. There's no particular time that they're scheduled for necessarily. But so long as they send their funds and those funds can be sent to you in that one, hour, or one 9 to 5, block of time, then we're good to go. So that's how cash closing works. It doesn't actually take place in a particular location. And that's because the whole process just can happen from the location of everybody's homes or conveniences. And then when it comes to the buyers getting a mortgage, we are going to shift into that conversation now. So buyers usually obtain one of a few different types of mortgages for their closings. One is a FHA mortgage, which is a first-time homebuyer mortgage, which you probably are familiar with. The next is conventional mortgage, which you're also probably familiar with. You also may have buyers that are buying your property with a 203K loan, and that could be FHA or it could be conventional. And that is usually an option that buyers choose if your property needs some repairs that need to be made in order for the property to meet its respective market value. So you would know if you have a buyer who's using that loan, and that loan is a little bit more complicated. There's some more steps that have to go into place for the buyers to actually get their mortgage. But those are common. And there's also VA loans, and VA loans are obviously for veterans only. And those have their own particular requirements, but they're not as much as a 203K loan. 203K loans are like the most complicated general consumer loans that you would probably find. Outside of that, there's also private financing. Buyers can get loans from other private people that they might know, which would also act somewhat like cash, but it's not cash because it's coming from another person. And then there's also hard money loans, which are usually, again, used by someone who's going to be making repairs to your property. And also not just repairs, but that the buyer is an investor and they are not going to live at the property themselves. So that's a whole other conversation when you're selling a property to an investor versus like an average first-time home buyer or a family that's going to be buying the property to live there. Now, all of this to say is that the easiest loan to deal with usually is a conventional loan, and that's because the conventional mortgages just have less underwriting requirements. And typically, if someone qualifies for a conventional, that is a really nice thing to know as a seller. It's like the next best thing to a cash offer. So FHA loans and VA loans, again, they just have additional underwriting requirements, and 203K loans have a multitude of underwriting requirements. But we're going to focus on the major things that kind of cross all of these loans, and that really the only thing that comes up that is consistent across the board is the requirement of an appraisal. So for most loans, like 95% of the time, you're going to have a buyer needing a appraisal done on the property. Some lenders have programs where they can waive the appraisal requirement, but it's not as common. So we're going to set your expectation that your buyer will need to do an appraisal. Some buyers are waiving their appraisal contingencies, but we're seeing that less and less these days. So let's pretend that your buyer did not waive their appraisal contingency, because that's kind of the worst case scenario, and we can back up from there. So if your buyer has an appraisal contingency, what does that mean? That means that the lender, when they order the appraisal, a third-party person will go to your property and they will do an appraisal of the property. The appraisal is a process where that third party goes to the home and they look at it and they look at specific requirements to determine if they feel that the purchase price of the contract that the buyer offered you, which you accepted, matches the market value. And that third-party appraiser is evaluating the property with their own professional opinion, which means that another appraiser may have a different opinion. So third-party appraisals are subjective, but they also are important because you can't just say, well, that one sucked, let's throw it in the trash, right? If the appraisal comes in and the appraiser thinks that the market value is actually less than the purchase price that the buyer offered, what that means is they will submit that to the lender. The lender will then adjust the mortgage amount for the buyer so that their loan is lower now. And now what that means is the buyer will have to bring more money in cash to make up the difference between the purchase price and the new loan amount, which is now lower. So the buyer actually has to bring a bigger down payment to give you the purchase price that they offered. So usually what buyers will say to protect themselves from that situation in attorney review is they will say, seller, if the appraisal comes in low, I have the right to ask you to lower the purchase price to meet the new appraisal value. And if you refuse, I can cancel. And so what that does is it gives the buyer the opportunity to not be obligated to bring that extra cash to the table without deciding that they would like to do it on their own. And it gives you the opportunity to negotiate with them and say yes or no, that you're willing to lower the price or not, or maybe you will by half, right? And you can negotiate with the buyer, but otherwise they're retaining the right to cancel. And this is something that buyers do need to protect themselves if financially they don't have the additional money to bring to the table, or if they feel like they really don't want to be overpaying for the property based on the appraisal value. So it's common that you'll find a buyer retaining this contingency. And sometimes buyers are willing to play around with this and say, let's say you put the property on the market for $100,000, right? And the buyers offered you 110. They may say that they will pay the appraisal value from up to $100,000 they'll pay you the purchase price that they offered. So if the appraisal comes in at 100,000 and it meets the asking price, right? What you put it on the market for, the buyers are essentially saying, we're not going to penalize you, seller, because we know that we offered more money to you. We offered 110. So if the appraisal value comes anywhere between 100 and 110, we'll offer you the 110. But if it comes lower than 100, then we have to talk, right? So sometimes there's different ways of maneuvering around this contingency so that there's buffers and protections, just like we talked about for the home inspection. And that's where attorney review gets really customized, and why working with an attorney who understands these things can really help you so that you're really customizing the situation to match you and the expectation of the buyer. So that's where the appraisal contingency comes in very important. Now, with other loans, let's just chat about VA loans and FHA loans. Sometimes the appraisal isn't just the value that the appraiser is looking for, it's also the quality of the workmanship of the property. So the appraiser may also require some repairs to be made. And generally speaking, a first-time home buyer or a regular general buyer who's not an investor is going to expect that the seller be the one to make the repairs to the property that are required for the appraisal to be approved. Now, the most common types of things that we can see appraisers bringing up are chipped paint here or chipped paint there. We also tend to see that they want like railings on certain stairways. So there's, generally speaking, a lot of kind of safety things. You also have some cosmetic things that the lenders want repaired. And this is just because the lenders are basically funding a very large portion of this transaction. And they want to see that their asset that they have rights to in the future, should the buyer not make payments on their mortgage, is up to a standard that they are willing to say, yeah, we're willing to give this money and hold the collateral, right? Which is the mortgage. So, or hold as collateral. So the repairs can also have the way that they can get handled can be dealt with in attorney review, where the seller could say, we will make repairs if there are any, up to a certain amount of money. After that, it's on the buyer. If the buyer and seller can't agree, we can cancel. So there's some ways that that can be worked out. Another thing that is important to note is that buyers generally don't want to make repairs to properties they don't own. And that's just something that lawyers also try to stay away from having happen, because it gets really messy. So a lot of times what could happen is, let's say the buyer says, hey, seller, we will make the repairs required, but we aren't going to be able to do that before closing. So will you please make them? We will reimburse you for those things at closing, right? And if closing doesn't happen, well, now you have a property that has repairs that are made that you will benefit from, because let's say you go to another buyer, they will now be paying you a value for the property with those repairs being done. So it might not really impact like the market value of the property, but let's say they are getting a mortgage of the similar type, then you can know, all right, like hopefully the appraiser won't come back and find anything else. But if they were going to find these things, I've already taken care of it. It is done. We're good to go, right? So it's important to keep in mind that that can happen. And there are ways to work around it and ways to add protections. But typically you will find that like buyers don't want to make repairs on a property they don't own. So that can be where it gets a little tricky. Now, buyers need to provide sellers always. If they have a mortgage contingency, they have to provide you what's called a mortgage commitment. That is a document that states that the lender has gone through the appraisal process. They've gone through all of the financing documents of the buyer that they needed in order to say, yes, we are willing to give the mortgage, but not just for pre-approving the buyer. That happened way earlier in the process, but we are also willing to give them the loan on this specific property, not just this buyer. We're willing to give them a mortgage wherever, whenever. We want to let you know, seller and buyer, that we've looked at the property, we've looked at the survey if there is one, we've looked at the appraisal, and we are willing to give a loan to the buyer to buy this specific property. That's really important. And the contingency is in place so that if the buyer doesn't get the commitment by a certain time, and there's no like automatic extensions or there's no agreement to extend the contract, that you could potentially cancel because you don't want to wait for the buyer to get a mortgage when it's already taken so long. So that's where it's not just a contingency for the buyer in this case. You also do have the opportunity, depending on the way it gets written in an attorney review, to cancel potentially at a certain time, because you're not going to be expected to wait forever for a buyer to get a loan. So once the buyer does get their mortgage commitment, typically a buyer's commitment won't be retracted. But if it is retracted, typically a buyer can cancel if it was retracted for a reason that was not their fault, which means like if they passed away or if they lost their job involuntarily, if they become incapacitated or disabled. There are certain things that can come up in a transaction where a mortgage may have been issued but then removed. It's very rare, but it could happen as well. So that's something you can expect to talk to your attorney about. But again, we're putting into the universe a successful transaction, right? And so your buyer had their appraisal, it went well, or we negotiated it successfully. Your buyer got their mortgage commitment. What happens next? So next video, we are going to talk about something that you'll be doing simultaneous to all of these things, which is getting your municipal certificates from the township or the city that you live in. And that is going to be all about the certificate of occupancy inspection and the smoke certificate inspection. So in the next video, we'll talk about that. And I look forward to seeing you there.